This is your LMAX Exchange technical update for Thursday, August 24th, 2017. Eurodollar. So the euro continues to refuse to extend a correction off this recent 2017 and plus 2.5-year high above 119 at 119.11, with the market instead deferring to a consolidation that could now lead to fresh upside, to fresh highs beyond that 119.11 high and up towards the 121 area further up. There had been initial signs that the market would look to extend lower down for a more healthy correction to the downside, possibly back towards 115 and certainly towards that 50-day moving average up around 115.50. But as of yet, there has been no ability for the market to break down, with setbacks below 117 being very well supported and leaving these weekly overbought studies unwinding while the market has been consolidating, as opposed to unwinding while the market has been pulling back. And so with this latest rise to the top side into Thursday trade, we can't rule out the possibility for a fresh upside extension now that takes out the 119.11 high, opening the door for a 200-point move to the top side towards 121. This follows a 200-point consolidation roughly between 119 and 117, and so a break above that 119.11 high would take us up towards a little bit over 121. Of course, at the same time, these technical studies are still extended, and the market hasn't done anything yet into Thursday that would alter the view of this consolidation, potentially leading to deeper setbacks. But for now, it's looking like the market has not been wanting to break down, and we could see one more push to the top side before the onset of a more significant correction. So don't rule out that possibility, which now is open for a break above 119.11 and towards 121 further up. Of course, if the market initially breaks back down below the low that we had seen back on the 21st, this week's low, the 21st of August, if the market breaks down below 1730, that would do a good job of potentially putting the pressure back on the downside for an acceleration of declines. Sterling dollar. So cable has finally broken down into this critical previous resistance, now turned support zone in the 127s. We had been talking about this for several days when the market started to pull back off the 2017 high above 132, and now that we're down here, while we could see setbacks extend a little bit more, the market should start to look for some formation of a base here in anticipation of that next big upside move to fresh 2017 highs and towards a key psychological extension at 135. Any setbacks that we do see in the sessions ahead, if they continue lower, should be very well supported ahead of 125.90, that low that was seen all the way back on the 21st of June, with only a close back below that level to delay but not negate what is a more medium to longer term constructive outlook for sterling dollar. Dollar yen. So dollar yen refuses to put in any form of a significant rally, with the market remaining pressure to the downside and that risk of retesting the 2017 low that comes in just above 108 at 108.13. That's going back to April of 2017. If the market trades down towards that level, it will then get interesting, because then we can say, will the market be looking to adhere to what has been more of a choppy range trade this year, or will the market be looking to break below this range bottom and accelerate to the downside, opening a more pronounced decline that could take this market down towards the 100 to 102 area. Euro Swiss. So Euro Swiss hasn't really been doing much over the past several days, although this follows a period of intense bullish price action, with the market breaking out above 112, trading all the way up to 1540, about the highest levels that this market had seen since the January 2015 collapse in Euro Swiss. So right now the outlook is constructive here, though we could still see some more choppy consolidation and even downside towards the 112 area before eventually the market considers a continuation of this newly adopted bullish outlook and this uptrend back above 115.40 and towards that 120 level further up. Aussie dollar. So Aussie's showing signs of potentially wanting to put in a lower top after stalling out in recent trade ahead of 80. This lower top would be below the 80.66 2017 high that was seen several days back in late July. But of course, this would need to be confirmed, and a break below recent support, which comes in around 78.08, the low from the 15th of August, would need to be broken to confirm that lower top and open the door for the next downside extension, taking the market back towards the 75 to 76 area. Dollar CAD. So dollar CAD has been in the process of pulling back over the past few sessions after the market had initially put in an impressive recovery out from the plus 2-year 2017 low that was seen back in July at 124.14. There is still prospects here for a higher low to carve out somewhere ideally above 125, but this would be only confirmed if the market was able to push back above the recent highs that we saw around 27.80, which would then open the door for a more significant correction up towards the 129.40 to 130 area. 129.40 is a key 38.2 fib retracement off of the 2017 high to low move. Kiwi dollar. So the New Zealand dollar broke down, extending its declines on Wednesday with the market breaking just below 72. The break of that level does potentially warn of deeper setbacks over the coming weeks, which could ultimately open the door for a retest of the 2017 low, which is more like a range low down in the 68 area. At the same time, if the market is able to bounce here and push back above recent highs that were seen at around 73.40, that would take the immediate pressure off the downside and suggest that the market is looking for a push back towards the recent 2017 and plus 2-year high at 75.58. But ultimately right now, the pressure does remain on the downside following this latest breakdown, which does potentially set the stage for a deeper setback eventually towards a retest of the 2017 low in the 68 area. SPX 500. The S&P 500 has been chopping around over the past several days. Technically, the market has been showing signs of tiring out, getting a little bit exhausted up here, putting in a lower top recently and a lower low. And so the question right now with this market is, are we going to see another lower top below the previous weekly high up around 24.70 in favor of a major downside extension on a break below critical support at 2400? If that does play out, it would be a significant structural development, marking the possibility for a decent, healthy round of setbacks in the weeks and months ahead for an overdue correction in this market in this intense bullish uptrend. Of course, again, the market would need to hold below the 2470 area and break back down below the low that we had seen in the previous week around 2417 for this to have a shot. And ultimately, as we've been highlighting, we would really need to see a close below that 2400 level to force a bearish structural shift. Until then, the risk remains on the top side, and we can't rule out the possibility for another push to record highs beyond the recent record highs that were seen early in August, just ahead of 2500. Gold. So gold continues to be very well supported on dips over the past several months, and the market has recently pushed up to a fresh 2017 high just over 1300, which sets the stage for a potential upside extension and a retest of the 2016 peak at 1375 further up. At this point, any setbacks that we do see should be ideally supported ahead of 1240, while only back below 1200 would compromise the newly adopted constructive outlook for gold.